This is Seth David for schoolofbookkeeping.com, bringing to you another special screencast. This time we're talking about many unhappy returns for retail clients. So you've got retail clients, and if you're watching this video, then hopefully you read the blog post. If you haven't read the blog post, check the description in the video. There'll be a link there which will take you over to the blog post so you can read all about it. We're talking about retail clients. We're talking about the end of 2014. We're talking about understanding what's going on in the economy and how that impacts your clients if you're an accounting or bookkeeping professional. And if you are the client, if you're the small business owner, then this definitely applies to you, especially if you own a retail business. So either way, whichever camp you might fall into, pay attention. In the Wall Street Journal this weekend, as of the time I'm recording this, they predict that the returns are going to be higher than normal this year. Certainly much higher than they have been in the last 2 years. And it occurred to me as I was reading this, what does this mean for my clients? How can I use this information to add value to the service that I offer to my clients as an accounting professional? And the answer that I came up with is I can give them the heads up that, hey, you can expect UPS, for example, as I point out in the article, is expecting to process a huge amount of returns in just the first week of January. So what can my clients do? My clients can prepare for this by trying to put together a promotion, right? Call it an unhappy returns promotion, where you can do something to give your customers the incentive to come in and exchange the merchandise and perhaps even buy more stuff. And the bottom line here is what we're doing is we're trying to protect our clients' cash flow. We're trying to make sure the cash flow stays positive instead of having to give all these refunds out based on all these returns that are going to come in. So we want to encourage people to keep their money with us and maybe even spend a little bit more. And if you read my previous post, because of falling gas prices, there's even more opportunity there, so that when you couple these two pieces of information, what you have is that much more incentive that you can sort of leverage to encourage your customers or your clients' customers to come in and spend the money they're saving by not having to pay as much for gas by purchasing more merchandise with you rather than just returning and getting a refund. So the issue is, what does this look like in QuickBooks? I've got a QuickBooks file up here with a sale that we've processed. So we have a customer who's purchased $500 worth of merchandise based on a quantity of 5 at a rate of 100. Right? Keep it nice and simple. So normally if I process a return, here's what happens. I produce a credit memo, and I have to use the original item that was used in the sale, right? Because we need to put this back into inventory. Right now, my inventory balance is $23.75. After I've processed this refund, here's what happens, and here's the problem. Because the other thing I want to be able to do for my customers is I want to analyze the return volume. And normally, what that means is I want to process refunds in such a way that they hit my sales returns and allowances account, which is a very standard account in retail. It might just be called sales discounts if you went with kind of the default QuickBooks chart of accounts for a retail business. Same basic thing. It's what's called a contra income account. We expect it to be negative, and it goes in as a direct reduction to income. The problem is when I process a refund this way, there's no opportunity to hit that account, because here's what's going to happen. Let's say I'm returning all 5 of them for the full $100. So I'm going to process the return. What's going to happen when I hit save and close is my profit and loss is going to zero out, because I've only got the one sale on here so far. Makes it easy to kind of see what's going on. It makes the action more glaring. So the sale's going to go away, the cost of goods sold going to go away, the inventory is going to go back up. So let's watch it in action. Save and close, and I'll retain the amount as an available credit. We'll click OK. And sure enough, my inventory asset is back up to $2,500. Accounts receivable is negative because I haven't given the refund yet. And as I predicted, my profit and loss has now zeroed out. It reversed the sale, and that's what I'm getting at. And as you saw, I just went through the screens. There's no place where I could have told it, hey, don't reduce the income. Just hit my sales returns and allowances account with that amount. So what I had you do in the blog post is I had you create some items. Right? We have merchandise, which is going to merchandise sales. This is where we're going to add the amount back to sales. Sales returns and allowances is going to the sales returns and allowances account. This is where we want it to hit as a negative to this income account, because again, it's a contra income account, so it's negative income. And then, of course, here's the original product, the inventory part that presumably would already be on your books. And then we're going to create this group. And this group consists of the above items. So it consists of the merchandise, the sales returns and allowances, and the product X. So let's go produce the credit memo now, done this way. We'll go in here, and we'll get to the credit memo. So instead of using product X, we're going to get rid of that line. and we're going to pull up product X return, which is that group that I created, right? Now, merchandise, we want to put the amount back in sales. Remember, this is a credit memo, not an invoice, which means this needs to be a negative, right? So -3 at 100 should put that amount back in sales. Sales returns and allowances is going to be +3 at 100 because that's going to produce the negative income that I need. And of course, we still need to get product X back into inventory, so that's also a +3 at 100 each. So we're assuming he's returning 3 out of the 5. And I'm doing this for a reason. I want you to see what it looks like when there's still some sales on the P&L. So we're going to return. We're going to have a return of $300. When I hit save and close, watch what's going to happen now. We're going to see the sales go back in, but now you're going to see the total sales of 500, and you're going to see the sales returns and allowance of -300 for a net sale amount of 200. And you're going to see the cost of goods sold come in at a different amount than the original total was. So let's hit save and close, and I'll say yes. And we'll still retain it as an available credit. And sure enough, there it is. Now I've got my merchandise sales at 500, my returns at 3, cost goods sold remaining at 50. I still have negative accounts receivable because I still have to actually write the check for the refund. And then, of course, I have my inventory asset now at $24.50, which is the difference of the $2,500 and, of course, this $50, which still remains out there as the cost of what we did ultimately sell, which was $200 worth of merchandise. And that, my friends, is how you can set up the infrastructure in QuickBooks to account for sales returns and allowances so that at a time like this, especially when you really need to analyze this, you want to be able to keep a close eye on this number here. So you want to start using this and then run comparative P&Ls, compare last year to this year. It might take some work if you have to go back and, reprocess the refunds using this system. If not, do it now so that you'll be prepared for next year. But the point is, if I can get my sales returns and allowances in a separate contra income account like I'm showing you here, this gives me an opportunity to do some analysis and work together with my client and say, okay, they're predicting a higher than normal return rate post-holiday season this year. Let's look at what our historical returns have looked like, and then let's think in terms of what we can do to mitigate our sort of liability or risk associated with the expectation that we're going to have a lot more people than normal coming in and returning merchandise that was purchased as gifts during the holidays. As always, if you have any questions, please reach out to me. You can email me, Seth@schoolofbookkeeping.com, or post your comments and questions here on the video on YouTube or over on the blog. We love getting your comments, and we love to respond to them. As always, I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.